And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show, presented by RIA Advisors.
And good morning. Welcome to Financial Fitness Friday. I'm Rich Rosso, certified financial planner, here solo this morning to get you through what we learned from the week and transition to the weekend. It's only about 130 degrees in the shade in Texas. We went from May to August in a day. I guess that's just what we have to expect. So the S&P rose yesterday 0.4, despite obviously price hikes warnings from Walmart, although Walmart had a good report. We'll talk a little bit about that. Dow rose 0.7. NASDAQ, however, snapped its six-day winning streak. But today, NASDAQ futures are up 54, S&P futures up 15, Dow futures up 134. So, listened to a little bit of the conference call for Walmart, and it was pretty interesting. Doug McMillon, I think, is one of the best CEOs out there. I guess it was about 10 years ago I avoided going into Walmart anymore. It was just too depressing for me. So a couple of years ago, I said, listen, gosh, we own this stock. I should go. Went into Walmart. First of all, I examined the parking lot, and I was shocked to see BMWs and Mercedes and all kinds of high-end vehicles in the parking lot, which portends or goes back to the story of what we've heard, that we have higher-end households now shopping at Walmart. And then you go in, and it's brightly lit, it's clean, shelves are stocked, and there are some items that I would usually not buy at Walmart because they didn't have them. So they did have them. So bit of trading up a little bit in the grocery space. So they had first quarter sales growth of 4%, profit growth of 3%, international sales up 7.8%. They had inventory, Doug McMillon said, was in good shape. So they expected good numbers. Now, they did talk about the tariff impact, that the cost pressure from all the tariff impacted markets in late April and accelerated in May. But they're going to move production. They're making their own deals. They're doing what they can to try to absorb costs within a specific category and not simply pass on that tariff cost to each item individually. So it's going to be a bit of a shell game here. You might see, in my opinion anyway, non-tariffed items see a little bit of a price hike, and tariffed items stay the same. They're just going to have to watch the flow of business. So what was very important, I think really great, that e-commerce finally achieved profitability, both in the U.S. as well as throughout the global enterprise. And I think that was a very important milestone for Walmart. Walmart has come a long way when it comes to their e-commerce. For me, sometimes I will order from Walmart. I just started on occasion to order some items from Walmart and online, and I wanted to compare it to the Amazon experience. It was so close. It's very difficult to tell them apart, except for the overall look of the website. So I ordered some bins, some plastic containers. They came in. They gave me communication on the way. They came in the next morning. But they also have items you can get later in the day. So when Doug McMillon came in, I remember that they needed somebody to really build out that e-commerce infrastructure. And I think he has done a great job. Just look at Walmart stock over the last 3 to 5 years. It's been an amazing performer. So over the last, say, 5 days, we have seen, in 1 year over year, so 12 months, Walmart stock's up 61.04%. That's not chump change for a consumer staples company, right? Okay, that you buy plastic bins for. So that e-commerce is really important. So the one thing we are seeing is sector rotation. So over the last 5 days, we have seen consumer staples sort of flat. But go ahead and look at the semiconductors, say the SMH, over the last 5 days, and you're going to see 5%. You're going to see SMH or semiconductors over the last month up dramatically. So in the beginning of all the Liberation Day stuff, we started to see this violent rotation out of tech into the safe havens in the market, so-called safe havens, consumer staples, utilities, healthcare, anything that you found boring, the market found exciting. Now, lucky for us, we've had our feet in both camps. We've had growth and we had value, and we saw that sector rotation. But frankly, last year we knew that, listen, this tech sector, these Magnificent Seven have to fall off the horse eventually. We needed the catalyst. Obviously, the Liberation Day was the catalyst. But now, right, with this talk with China, although what I think is the market is giving Steve Bessent some grace here, we still don't have a deal. We have a waiting period to a deal, but there's always a risk, right, that there isn't a deal. So there's a lot of tremendous headline risk in markets, and you are short-term overbought. So, we still have a short position in our portfolio just as a hedge, very small percentage, along with some additional cash that we will put to work. So we're trying to navigate this. And what I had mentioned before is, listen, we have been in a government-driven economy since the financial crisis. And it culminated in these trillion-dollar Recovery Act plans that put checks into everybody's households and closed businesses, right? That to me was, the zenith of what you show as a government-driven economy. And look at the number of government jobs that were on the rolls, right? So we were slowly moving into, I depend on the government for almost everything, to where now we have someone that's coming in that's trying to, I hate to say it, but shift the foundation under us. Well, I don't really hate to say it. It's just the way it is. But, that transition back to the private sector is like spinning plates on a moving floor. So I remember when they used to do it on Ed Sullivan. That was amazing. I was very little at the time. But you always had these guys that were amazing, spinning these plates on these sticks. And you're going, how the heck did they do that? Listen, we're doing that as portfolio managers. We're trying to hedge against risk. We're trying to add to positions that have been beaten up. And we're trying to monitor the whole process and build cash at the same time and lower equity exposure. So we're raising equity exposure in some areas, lowering it in other, then hedging. So let me say, for money managers this year, you're earning your keep. You're earning your keep. And I've said this before. I like this year better than last. And I'll tell you why. You have to be a good stock selector. You have to be someone who actually does some research, where last year I didn't have to do much of anything. And frankly, a lot of people I meet with are still burned this year in their stock portfolio. And you know why? Because they chased the Magnificent Seven, and that's where most of their equity allocation was. And that wasn't smart. Well, they're feeling a little better over the last few days, for sure. All right, we get back. We're going to talk about Social Security. In the new Tax Act, tax-free Social Security. Is it a dream or is it deception? We'll be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors. 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And we are back. So I created a new program about retirement income and to help people understand how to craft a retirement income paycheck, right? Cash flow is the lifeblood of retirement. Yes, obviously you need growth because hopefully you live a very long time in retirement. And then you also might have parceled out a legacy asset that's going to be for children and grandchildren. And of course, that needs to grow as well. But there have been a lot of great, when I first started in this business, and I started at a company in 1989 called J.T. Moran, which is the subject of the movie Boiler Room. And I went, oh my gosh, what exactly is going on here? They had sponsored me for my Series 7. A lot has changed. A lot has changed. And what hasn't changed in the business is this focus on accumulation. You know, how to save money, how to put money into plans or managed accounts that pay a fee, you know, selling managed product. It's only gotten bigger, but guess what? We're an aging population. And we need to understand the rules of accumulation are very different than the rules of decumulation. So in this retirement income empowerment workshop, I put together the strategies for secure, tax-effective, inflation-protected retirement income. You want to turn some of those savings into lasting income. Protect against, obviously, inflation and market volatility. Reduce your retirement tax burden. Yes. We're going to talk about Social Security taxation, but above 2 threshold levels, your Social Security is either 50% or 85% taxable. It's not so visible to you. I call that the backdoor tax. So we're going to talk about this, but this is a live, in-person event at the Hyatt Centric in the Woodlands, Saturday, June 14th at 9 a.m. Register now because seating is limited. This is free. Nobody's selling you anything. This is an education. If you are Tim Allen in Tool Time and you need to know, how do I turn to Wilson? How am I now going to be Wilson, who has a different set of goals? And I need to understand how I'm going to be taxed. The myth is you fall into the lowest tax bracket in retirement. That used to be the case when I started. Not anymore. We need to help you understand how to build a paycheck and how to build your guardrails and how to understand how this works. So I'm real excited about this. Danny and I will be presenting this. This is education for you to come and listen. So if you've come to our retirement workshops in the past, they were very holistic, soup to nuts. We focused on every part of the process. Here, it's all about cash flow. It's all about income. So hopefully we get to see you there. Sign up at realinvestmentadvice.com. Social Security is a very important part of your income equation, right? It's without it, most people would have a hard time. I will tell you, even people who have been what I can deem super savers and their plans marginally work, adding Social Security to that equation, a guaranteed income stream, really changes the climate and it really reduces the vulnerability someone might have to downturns in markets and the variability of those assets. I spoke with someone yesterday, Brent. We waited until age 70 for him to take his Social Security, very healthy. He's got a younger wife, and she has not placed so much money into the system, right? She has not paid so much into Social Security. So I was more concerned about her survivor benefit. Do you know, with cost of living adjustment, I'm going to touch on this in a minute, his monthly paycheck is going to be like $5,100 from Social Security. Listen, the last time I looked, that wasn't chump change. We can all argue that, if I would have had the money, I would have invested it and it would be $8,000 a month, whatever it is. I'm saying we're working with the system we've got, and we've got to maximize for you the system that's in place, right? Also, pensions are great, but pensions don't usually have cost of living adjustments. You certainly can create your own pension that could be tied into an underlying market index that will take care of your inflation equation over time. But we have these cost of living adjustments for Social Security. So I don't know, but President Trump signed an executive order to lower prescription drug prices. But Mary Johnson, she's an analyst for Medicare and Social Security. She's a policy analyst. And she was looking at we're trying to anticipate what new COLA estimates might be, because we might see a tick up in inflation over time, or it'll stay where it is. But 2.4% may be where this figure winds up. We'll keep you up to date on that, on what your cost of living adjustment. So she looks at it on a monthly basis and figures out where it's going to be. The tariffs last month, maybe consumer prices go up. I still think that, again, that narrative is a bit of a dog whistle. I don't think, even we wrote about it, Michael Leibowitz wrote a great piece about tariffs and inflation. Just go look it up on the website. We'll see how this actually impacts cost of living adjustments. So she's thinking, well, eggs are up in price, food, beverages, everything's up in price. So therefore, COLA is going to be up. But I will tell you, when you look at the latest inflation numbers, you got to go into the categories, look at the core numbers, and see where you are year over year, month over month. Where you see some of the biggest pain, I think, in the core services. So core services, within the CPI calculation, they account for about 64% of the index. So the weight in the CPI. So month over month, 0.3 as of the latest numbers, 3.6 year over year. But it's some of the areas where you would think you would see increases, like medical care services insurance. How about auto insurance, Brent? House, homeowners insurance, right? We have seen nobody talk about that, but it's very difficult to bring those prices down. But food services, food away from home. So someone, was telling me yesterday, Rich, let me take a step back. This is economics. This is a social science. You live in the science. You live in the soup every day. If you invest, you're an observer. Okay? If you're an investor, you don't live in a hole. You observe people in restaurants, how many tables are people are sitting. You are much more economically sensitive. Your spidey sense for economics picks up a bit because you are invested in the economy. And I think that's one of the benefits of stock investing that people do not talk about. And I told this to my daughter. Once you own stock of an organization, you get into this matrix of sensitivities to what's going on around you economically. You get out of your own head and you try to get into other people's heads. And my daughter's really great. We went to Sonoy, Georgia, where they filmed The Walking Dead, and there's a restaurant there called Nick and Norman's, and it's one of the actors and one of the legendary producers set up this restaurant, and she owns stocks, and we were sitting at the bar in the afternoon. We're taking a break, walking around. It was like, 85, 90 degrees in Georgia, and it was in the summer. And she goes, Dad, it's 2:00 in the afternoon and this place is pretty busy. I says, yeah. So she goes, she's become more sensitive to looking at things. So because when I talk to clients, they'll also say, gosh, I was in Costco the other day and it was mobbed, or I was at Walmart, or my gosh, this place looked really empty. And I'm noticing people are canceling vacations. When you invest, you become more sensitive. So when clients tell me, oh my gosh, people are eating out more, I see, restaurants are filled. Well, food services, food away from home, says about 5.6% of the index. Month over month, 0.4, but year over year is up 3.9%. So we are seeing some inflation in that space. Could be wages, demand for product, whatever it is. So people are still spending. And I'll give you another reason why. When you look at household debt to income ratios, you're at some of the lowest levels I've seen in a long time. When you look at, say, 2006, 2007, and you look at total household debt as a percent of disposable income, you are at 116%. You're now at 81%. Now, I'm not saying that's great, but what I'm saying is you are seeing that over the last few months, especially, people are putting a little bit more money away. And they're spending less of their disposable income, maybe in anticipation of inflation. Maybe they're worried about their job. Who knows? So we're on a good trend when it comes to household debt, because you can always say, listen, oh my gosh, look at household debt. It's through the roof. People don't save. But you got to look at it as a percentage of disposable income and see where you are. Now, I will say probably, and Lance would have these numbers, in the 60s and the 70s, household debt as a percentage of disposable income was probably 20%. And I might be being kind about that, right? That was a generation that did not believe in debt. So that was a very different thing. So when you are looking at numbers, you have to compare them to history. You also have to compare them to other things. You got to look at debt, but you got to look at income to service the debt, right? When you're a stock investor, you are observant. You are looking at things around you in a different way. I just know that from investing in stocks since I'm 13 years old. What kind of tips was I getting as a paper boy? Were they going up or were they going down? We'll be back. We are going to talk about that tax-free Social Security that's in the tax bill. Is that a dream or a deception? Maybe a little bit of both. Be right back.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I'm a little disappointed. I was expecting Crocodile Dundee to come back from this trip and have alligator tooth necklaces or some tribal tattoo, where he was adopted by some tribe.
The Real Investment Show podcast.
You don't know what I'm wearing underneath this suit.
Same show, your schedule.
You didn't come back married to some tribal princess or something?
No, I did not. Yeah, I can barely keep up with one, much less multiple.
At realinvestmentadvice.com.
They must have some really good time management.
Exactly.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell report, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And we're back. So, I would think most people who listen to the show and on the chat understand that Social Security benefits are subject to federal income tax on combined income or a modified adjusted gross income that's part of something called a provisional formula, which is your adjusted gross income plus your tax-exempt interest. So if you have municipal bonds, that gets thrown into the soup, plus 1/2 of your Social Security income. Yeah. It's a wicked formula called provisional income. And if you're married filing jointly, and by the way, these numbers I'm going to give you have never been indexed for inflation, which is a shame because one of the things as far as taxation on Social Security, you don't even have to remove the taxation, but you can go ahead and index these levels if, say, for example, it was too cost prohibitive to make your Social Security benefits tax-free. So if your combined income, remember, that's that provisional income formula, just not what you see on your AGI, right? You got to add some stuff back. There's also some other cryptic stuff you have to add back, like student loan interest and other things, but I'm just giving you the main points. If your combined income is below $32,000, none of your Social Security benefits are taxed. If your combined income is between $32,000 and $44,000, you may have to pay income tax on up to 50% of your benefit. That's your first threshold. So if your provisional income, you have to take that number and subtract it out from the threshold number. So depending on where you fall, right? If provisional income falls between 32 and 44,000, I got to look at the difference between where I am in that threshold plus that provisional income. There's going to be a number that's produced. It'll give me an idea of what percentage or how much of my Social Security is taxed. But then, if once your combined income hits 44,000, you're paying 85% of your benefits could be taxable. So there's a point where you go, I give up, because $44,000 in provisional income is not tough to get to, especially if I'm taking money out of my IRA. Maybe I work a part-time job. Then you're trying to tell me that half of my Social Security income goes into that formula? Like, you want me to fail. Like, why not just tell me my Social Security benefits are taxable no matter what I make? Because these thresholds are ridiculous. So in part of the act that we see repealing taxes on Social Security. So think about this. If you're a higher, and I'm going to make up a number here, but if you're creating $100,000 in retirement income a year, you're in the top 0.1% of income generators in retirement income. You know, I give up, my hands are up, 85% of my Social Security is taxable, right? But if I'm stuck in the wedge where a lot of people are, in the middle, between these thresholds, right? I'm stuck in there. This is what I call the tax torpedo, right? It's going to blow me out of the water. And you'll see that many middle-income people fall into this space. Most retirees. So for them, this repealing taxes on Social Security resonates with everyone. So they'll get bigger monthly checks. But we have to look at the downsides. The trust fund depletion, the acceleration, would it be at least 3 years? So instead of 2034, you'd be at 2031. The progressive nature of the whole program itself. So Morgan Stanley, Monica Guerrera, executive director, she's head of policy. She put together what she thought, would happen. So this is a change wave. And I don't know which way it'll go, because if I said to you, you're probably not going to get taxed on your Social Security, would it impact your savings and withdrawal rates? Sure. What about future generations if I'm going to deplete the trust fund earlier? Sure. How will this be looked at through court systems and so forth? In other words, the planning impact is going to change. Say it happens. Yeah, it's a good thing for a lot of people. It'll help them to spend more, because I will tell you, most people who have, say, variable assets, and Social Security is just an add-on, but most people who depend on variable assets like stocks and bonds to create their income, they are underspenders. People who the majority of their retirement income is guaranteed, they spend almost everything, because if I spend my check in January, I'm getting one in February. But what if the market's down 10% in a month? Would I change my withdrawal rate? It could happen. Could I cancel my vacation? I might. So some foundation of guaranteed income that circles your variable assets is very important. And for most people, that's Social Security. So if you're telling me Social Security benefits are tax-free, I may just not save as much. Maybe I would lower my withdrawal rate, which means I'd have a bigger legacy asset, right? So we have to understand the impact of this change on your financial plan. So this is a big debate. We have to see, because again, we talked about the trust funds that would be depleted sooner. But let's see here what she says here, because this is a pretty interesting report. Oh, so this is from Wharton School's federal budget model research. Benefits could result in income after taxes increasing by 0.1 to 1.2%, depending on tax brackets after 10 years. But you would think that's pretty modest. So they did an illustration. They did a scenario analysis. Individual claiming Social Security with $1 million in retirement portfolio, say a 6% annual spending rate over a 20-year period. Then an assumed 30% cut to benefits to adjust to the projected trust fund shortfall, right? In other words, cutting that Social Security benefit, those taxes, adds almost $400,000 of additional asset value, especially in a high tax state like California, and $300,000 in additional asset value in a lower tax state like Florida. In other words, you would probably be spending less from your variable assets and depending more on the guaranteed income that you would have because of the taxation that's not going to occur on your Social Security. So the no tax scenario is appealing because at the end of the game, you'll have a bigger retirement portfolio. And then you got to say to yourself, well, now, gosh, I've got to spend this money. Or do I have a bigger legacy asset? Do I have a bigger charitable asset? We do not know the vibration for this trick, how this is going to vibrate out or, trickle out through everything else. It's going to touch every part of your plan if Social Security benefits are not taxed. And again, most middle-income workers and retirees love this idea, and it's understandable. And I do understand why this tricky provisional income formula ticks a lot of people off and doesn't seem fair. But we have to make up for it somewhere. So when you look at the Social Security wage threshold, your payroll tax, it's roughly $176,000. In other words, up to that point, once you exceed that number, you are no longer paying into Social Security. If you increased that base, you could probably do this. In other words, if I said instead of $176,000 on that wage base index, and that does get indexed, maybe it's $300,000. So up to $300,000 I'm paying into Social Security. So that hasn't been talked about, but that is an easy way to allow this to happen. But people would go, listen, you're raising my taxes. And I understand, listen, I used to be a fan of paying taxes. I'm not a big fan anymore because I see where money goes. You know what they should do, Brent? With your tax return, give you a form. And on that form, it says, where would you like your tax dollars directed? Up to 100, like when in your 401k, when you look at all your different selections and you put 20% here, 30% here to equal 100. Where, sir, Mr. Clanton, would you like to see some of your money go? That would be good. You tell me. I'm going to tell you as a taxpayer where I think my money should go.
Is there going to be an option for back to me?
No, there's no option there.
Well, then forget it.
Silly. But you might say, if your Social Security is not taxed, you might say, if you raise I'm working, and if you raise my payroll tax a little bit, I might be okay with that because at least I freaking know where the money's going. It's helping out others, right? Because this is a pay-as-you-go system for the most part, right? And we don't have enough workers. So this tax-free Social Security is a bit of a dream, and it could be a good dream. But it could also be deceptive too, because we don't understand how it fully affects everything around us. Mostly positive, but that trust fund is something that needs to be watched and bolstered. So, all right, we get back. We're going to talk about a few more things. Stay tuned for our last segment.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Now, stock futures are heading up nicely. Dow futures up 148, S&P 18, NASDAQ 67, 10 years at 4.4. But this could all go right down in the toilet when consumer sentiment comes out today. We're going to see what that overall looks like. You know, interestingly enough, when you look at AAI members and how they feel about the stock market over the next 6 months, the historical average is roughly 37.5% bullish. You are, and at the whole Liberation Day and all that, you were at 21.9%. So as of 5/14, you were at 35.9. Nice move. Nice move. But you're not anywhere near the one-year bullish high, which is 52.7. So this rally could continue for a while. And what I've learned yesterday, I was doing some homework yesterday, you know, institutional investors obviously do drive markets, but man, retail investors, they buy the dip. They have been coming in force and buying the dip. And maybe it's a generation of investors who believe that the Fed will come and bail them out. That's what they're used to, right? I know President Trump would like to change that, right? Well, maybe. He wants the Fed to lower rates, but then they're focused on supply chain disruption. You know, we didn't really seem to care about supply chain disruption as much because that was going to be transitory. Remember transitory? I remember transitory. Yep, took one this morning. Worked like a clock. Nope, that's not transitory, Miss Yellen. That's not transitory. Well, maybe in some ways it is. So we have a Fed that's feckless and have no idea which way to go. They go ahead and they lower rates last year when the actual overall rate of inflation was higher than it was today. So, but this tariff thing, I call it TDS, Tariff Derangement Syndrome, and that is going to continue. So you're probably not going to see rates drop for a while. However, the tariff narrative is going to be much stronger, at least in the short term. Thus, you probably have more room based on investor sentiment to move ahead. But we're going to see how consumers are feeling. I read somewhere, and I didn't fully go through the whole piece, that President Trump's approval rating is notched up a bit. I don't know if this translates when it comes to consumer sentiment. We're trying to get closer to crystallizing the tax bill, because we have this, obviously, Tax Cuts and Jobs Act that's going to sunset, right? And my thought is it is going to. Or it's not going to look anywhere near what it looks like now, right? So we still have in our software, when we do planning, we are allowed to, we change a lot about our planning software. When it comes out of the box, it's usable, right? That software could be applied immediately. And I would say most advisors do that, because the companies that provide the software, they do a really good job of looking at forward-looking returns. They have a lot of sources to try to make it as easy as possible for an advisor. At RIA, we like to make things more difficult for everybody. So we go in, we adjust inflation expectations on certain items based on the Atlanta Fed Sticky Price Index, Cleveland Fed, look at all this data to tell me whether or not we should be increasing rates of inflation on certain things, especially long-term care, medical insurance, Medicare premiums, and so forth. So we have to adjust that. We also adjust forward-looking returns based on Lance's Cape 5 and some research from a company called Research Affiliates, which I think is one of the best comprehensive data and report analysis I've seen on markets next to Lance. So we keep the fact that the Tax Cuts and Jobs Act is going to sunset. But there are a few things that are brewing in this first draft. This is part of Ed's slot. This is a 389-page version of the bill. So when I see articles that say to me, this tax bill is a tax cut for the billionaires and the wealthy, I sort of laugh. First of all, we know how much the top 10% pay in taxes for the country, but put that aside. When you go to the tax foundation and you start running numbers, or I started running numbers for middle-income people with children, without children, singles, everybody is going to get a tax increase if this bill sunsets. Nobody says that. Nobody talks about that. This is only a tax cut for billionaires. Most billionaires have money wrapped up in illiquid assets that they use to sell for capital gain. I think Warren Buffett once lamented that his secretary pays more in taxes than he does. Yeah, you're not hitting the right tax. Most people, they live on income, not dividends and interest, income. I mean, working wage income, right? So everybody who's working is going to get a tax hike if this bill sunsets. That's just the numbers, okay? This is not a political thing. If I looked at those numbers and ran those numbers myself and realized that that's not true, I'm happy to tell you that. So this is a preliminary estimate from the Joint Committee on Taxation finds the draft, this is the first draft. Right now, we're probably late into the second, would cost $5 trillion over 10 years. And that's the Tax Policy Center wrote in a recent blog post. So that's more than half a trillion more than the House budget resolution permitted under a best case scenario. So one of the things they're looking at is the exemption resets for your estate tax to $7 million per person in 2026. In the new bill, they're looking at the base amount, $15 million per person, or $30 million for a married couple, which means Brent's still in trouble. He still has to do his trust planning. And this plan to be permanent, okay? But I'm like, okay, this is great. Maybe you are helping your billionaire buddies, but there are a lot of businesses ranches, people who've worked their butts off. And I'm not saying people who made $1 billion didn't work their butt off. They created something, and they create jobs, and they do a lot of other things. But I'm more excited about the QBI deduction, the Qualified Business Income Deduction, which is currently 20%. But they want to increase that, make the deduction permanent, and increase it to 23%. So depending on the kind of business that you have, this is a sizable deduction. There's all kinds of things, whether you're a specified or non-specified business, like a lot of times advisors, depending on the threshold, accountants, CPAs, all that, they're not, they not benefit from that. But a lot of small businesses do. So increasing, to me, that QBI deduction to even like 25% would be crucial. Now, also, they're going to remove miscellaneous itemized deductions. So let's talk about this. They're going to be gone permanently in the first draft. And listen, how many people itemize today? 90% of taxpayers no longer itemize. So, but advisor fees, some of the fees I think you pay to your tax preparer used to be deductible as miscellaneous itemized deductions. So that would be gone permanently, again, along with any deduction for tax preparation fees. So they wanted, though, in the bill, increase the standard deduction. $2,000 or more for those filing married joint. So I don't think that that's bad. So the overall income tax cuts, so you have marginal brackets, 22, 24% are pretty wide, pretty expansive. And we use those brackets a lot to do surgical Roth conversion. But there was talk of a wealth tax, increasing the top bracket to 39.6. But it's not in the draft. And I think President Trump said, he said, I don't mind, but, I don't think that's going to go over very well. So there'll be more and more markups. There's also, again, we're on this whole thing of demographics, right? I think Elon Musk probably put that seed into the president's head. And we're going to maybe pay $5,000 a couple, you have a baby. Or maybe we're going to increase what's in there, the child tax credit, increasing it maybe to $2,500 per child from $2,000. And that should help with child care expenses. But as Lance talks about, and in this core CPI bill, in this CPI number that I looked at, child care goes up more than the standard rate of inflation. You start increasing the child tax credit, I'm also increasing my fees over at the daycare. So keep that in mind. Now, here's the biggest controversy. SALT cap, right? The deduction limit for state and local taxes. They want to put it at $30,000 and put income limits in place. This one is big because you got a lot of Republicans too, wealthy states, and they want the SALT deduction back. So this is by no means, this is a first draft, 400 pages plus. Who knows what this looks like? But as a planner, as your advisor, and also your tax person, we need to know exactly what this bill is going to say and try to help you implement it properly. That's all we got. Have a great weekend. Lance is back on Monday. RealInvestmentAdvice.com. Check out the blog. Check out Mike Leibowitz's latest article. Sign up. Retirement Income Empowerment Workshop in the Woodlands. Hope to see you there.